Joining our conversation now, I'm pleased to say, is Sam Huszczo. He is founder and CIO of SGH Wealth Management, joining us on set. Sam, it's great to see you again.
Hey, Mercury must be in retrograde again. I'm back, so get your sage out, whatever it might be. But
there you go.
When you were talking before, people are selling off. It's like, why don't people believe in this bull? It's any old bull is going to have some scars on it. Mm-hmm. This is like, to me, the Keith Richards of rallies. He's smoking, he's drinking, he's partying his whole life.
He's still alive.
Yeah, and he's healthier than people 30 years younger than him. So why can't we just look at it and say, hey, be thankful that earnings are growing faster than the stock market? We're seeing valuations come down, not because the markets are coming down, but because we're actually seeing growth in earnings, which got PE ratios at about 20.5. It's overvalued, but it's not crazy. And usually in a zone like this, the 3-year mark is usually where it's a hurdle. After you get the 3-year mark, historically, these markets go usually to 4, 5, 7 years. They don't usually just stop right here. So I think people need to get on board with this.
What's that Steve Carell gif? Thank you.
You guys are speaking the same language.
Oh my God. Every single column I see is, it won't last. This is a worry. That's a worry. Can't we just enjoy a nice bull market? Everything's fine. It's been great. Like, what's wrong with saying that? I get it. You won't get the clicks. Okay, some worry articles get all the clicks.
For sure.
But there's a gap between the noise and the worry and the actual market. What do you make of that?
I mean, so the term irrational exuberance, that Greenspan, that's kind of what we're talking about. When he coined that phrase, the markets went up another 105% after that until the next bear. So we just want to be worried about things. But I me's a two-edged sword, right? Because then what we're seeing the flows are in is all greed investing. And so within that side of things, it's 38 days into SpaceX. We have a double levered ETF that you can buy options on. We can leverage a leveraged product. That is not hot sauce, Eric. That is, wait for it, Katie.
Tell me.
Pregnancy cravings.
Jesus.
That's peanut butter on a pickle. Like that, it doesn't make sense. We don't need that. And is this a sign that it's 2008 and mortgage? No, it's not all that. We're just in a greed mode. And, within that, the markets are psychology and math. Like Kathy Wood parties way too hard for me. Cash flow models have a place. They're not an infinite tool, but why would you want to throw out a tool? Math has survived every market cycle. But on the flip side, we're factor-based investors. Fama French parties way too hard. They're saying perfect markets, efficient market pricing. That's not right either. There is a middle ground to everything. And one of the bad actors within, this whole greed movement, I would say, is the private markets as well, too. We have just beat up the word democratization. That has to be the hardest working word. Oh my God. We've watered it down to nothing thanks to the 250-day year anniversary or whatever. But by day, it's doing good work. We're getting 1-year-olds into the stock market, which is kind of a funny statement. But, it is good. They have long time horizons. Right. It gets more owners. By night, it's hawking private credit to retail people that don't have the time horizon for it.
Well, Sam, I want to talk about your positioning in all of these different cross currents that you lay out, because I'm taking a look at some of your key holdings. You're an RIA. I see JMOM, which is a momentum ETF. We were discussing it the other week. I see some equal weight exposure. I see some small cap exposure as well. So talk to us about, how you put sort of what we're talking about into these different puzzle pieces.
Yeah, JMOM gets a bad rep too. Like it gets lumped in with the meme stocks and the IPO darlings and probably some of the greed stuff that I said before. But it's a rotating investment. It has a 90% turnover. JMOM is like a Porsche 911. It's fast. It's trying to move. It does have airbags. It might survive a pothole or two, but it could crash. But the recent turnover is going into healthcare, telecom, discretionaries, things outside of it. And let's be real, it is a memory stock play in the moment, but it's reduced its holdings in AMD and Micron and other things of that nature. But where great investing in is not just one investment on an island. Where the magic happens is if you can find two strategies that work on their own, but they're uncorrelated with each other. So you set up your next trade. Instead of looking at next week, look at 2 years from now. And that's where equal weight does come in. The correlation between equal weight and momentum is negative 0.52. So it's going to go in different directions, and both of them are beating the markets today. Because thankfully, well, and let's give some peace to the Mag 7. It underperforms for 6 months, and we're already trying to coin new acronyms like mangoes. Like, we have no loyalty in this business at all. But, you know, within that, moving on, it's in industrials, it's in real estate and things of that nature where, you know, people are selling the shovels as opposed to mining the gold in AI, basically. So
I want to go back to the leveraged single stock ETFs because you talked about that briefly. South Korea is going to halt new listings of those. That's a pretty clear sign to the U.S., isn't it?
Yeah, I mean, yeah, of course, but it's not going to stop us. Like, the argument years ago was, hey, should we even have active ETFs? And now the argument is, should we have ETF parlays? You know, like, hey, if SpaceX goes up 2% and the Fed lowers rates 0.25, you get 10x your money or something like that. It's just, it's getting out of hand. It's getting out of hand. And so I would say that's where you just notice emotions. Again, don't get away from your math, but say, hey, if greed is creeping into the marketplace, why don't we get into some other areas from an emotional standpoint as opposed to chasing that shiny object for forever?
Right.
So within that, too, I mean, I do think the flows are missing small caps. Small caps has had an interesting run. The fastest first 6 months of the year in 20 years. 2/3 of issuances are above their 200 moving day averages.
Right.
And the shorted stocks are the ones that are underperforming. So quality matters on that side of the fence, too. And so some people are saying that on the small cap side, that it's a sector play. It's just that regional banks are doing well.
Right.
But regional banks doing well, that's a great sign for the economy. Regional banks, you know, rely on people paying their bills. But the stat I would leave on small caps is out of all 11 GIC sectors, out of all 11 of them, every single one of them, small cap is outperforming large cap. So that's a sector, or that's a factor play. That's a size play, not a sector play.